Yes. Yes, sir. Very, very good evening, everyone. How are you all? Everyone fine? So, in this video, we'll do the revision of Accounting Standard 22, that is accounting for income tax. Once again, very important topic from exam point of view. One question of 5 marks can be asked in exam. Also, MCQ question of 2 marks can be also asked in exam. Got this point? Yes, sir. So, this chapter deals with only taxes on income. Taxes on income means this accounting standard does not deal with any other taxes. Any other taxes means it is not applicable for GST or any other indirect tax. Got this point? Yes, sir. Now when I am saying taxes on income, so it will be applicable to all types of taxes of income, whether it is foreign tax or domestic tax. So taxes on income will include all domestic and foreign tax which is based on taxable income. Now before I start the chapter, we should know some accounting term as per AS 22. So first is, what is accounting income? Accounting income means, in simple word, it is profit before tax as per SOPL. So whenever we prepare statement of profit and loss, in that we calculate profit before tax, so that profit before tax is accounting income. So it means profit or loss before tax expense for a period as per statement of profit and loss. What do you mean by taxable income? Taxable income is any income which is calculated as per Income Tax Act, on which we pay or on which we calculate income tax as per Income Tax Act. So it is the amount of income or loss for the period determined in accordance with the tax law, based upon which income tax is payable or recoverable is determined. Got this point? So taxable income, I hope if when you have done income tax, so in that you have already calculated taxable income, based on which we calculate tax expense, means tax expense as per Income Tax Act. What is the tax payable or recoverable? Now what is the tax expense? So in accounting, tax expense is the aggregate of current tax and deferred tax. So when I say current tax plus minus deferred tax, that is known as what? Tax expense. So what is current tax? Current tax is the amount of tax which is determined in respect of taxable income of current period. So it is the amount of income tax determined in respect of taxable income for that particular period. What is the deferred tax? It is the tax effect of timing difference. Now of course I need to explain what actually the timing difference mean, correct? Now so any tax calculated on timing difference as per this chapter is known as deferred tax. So how to calculate the deferred tax, that we need to understand. I just give you preview of this chapter. First we need to find out accounting income. Accounting income. From this accounting income we should compare this accounting income with taxable income. Now the difference between this accounting income and taxable income can be due to two reasons. So the difference can be due to two reasons. One is known as timing difference. We call it TD, and one is known as permanent difference. We call it PD. Correct? So timing difference, whatever timing difference there, on this we apply rate of tax, and this will become deferred tax. Correct? But on permanent difference we don't calculate any deferred tax, no deferred tax. Correct? So it means first we need to find out difference between accounting income and taxable income. Then the difference can be timing difference, or it can be due to permanent difference. On permanent difference we do not recognize any deferred tax. On timing difference we recognize deferred tax. Now if this deferred tax is payable in future, correct, then it will be deferred tax liability. And it is recoverable in future, if it is recoverable in future, then it become deferred tax asset. Now we need to understand when to recognize DTA and when to recognize deferred tax liability. Correct now. Now for deferred tax liability, what journal entry will do? Ki deferred tax asset. For deferred tax asset, what journal entry will do? Deferred tax asset to, can you say, to deferred tax income, means this will give rise to some income, or we can say it will reduce tax expense. It will reduce tax expense. Correct. So the journal entry become deferred tax asset account debit to deferred tax income, or we can say to tax expenses. Deferred tax liability, what journal entry will be there? Deferred tax expense, or we can say tax expense account debit to deferred tax liability, to deferred tax liability. Understood? It means, can I say, whenever there is a DTA, it will reduce your tax expenses, therefore will do current tax minus deferred tax in this case. So it will reduce your tax expense. Correct. And whenever there is a deferred tax expense with DTL, it will be added to current tax, will do current tax plus deferred tax. So this will become what? This will increase your tax expense of that particular period. Understood this much? Now let me explain you what actually timing difference means. So timing difference are those differences, between taxable income and accounting income for a period that originate in one period, that are originated in one period and are capable of reversal in one or more subsequent period. Means any difference which originate in one period and are capable of reversal in one or more subsequent period, that are known as timing difference. Correct. For example, expense which is disallowed under Income Tax Act in this year. So any expense which is disallowed under Income Tax Act in this year but will be allowed in future, that become a timing difference. Or we can say any expense which is allowed under Income Tax Act in this year and will be disallowed in future, this is also timing difference. Means any expense allowed in current year will be disallowed in future, or disallowed in current year will be allowed in future, that will give rise to timing difference. Example, we can say depreciation. We know that depreciation under Income Tax Act will be higher as per books of account, because in computer we charge depreciation at a rate of 60%, but in books of account we don't charge that higher depreciation. It means, can I say, depreciation, excess depreciation is allowed under Income Tax Act, which will be disallowed in future, that is a timing difference. Correct. Or there are many expenses. For example, preliminary expenses. We know under Income Tax Act, preliminary expense will be allowed in 5 years on equal basis, but under books of account that will be expense in the year in which it is incurred. So can you say it will be disallowed in the first year, will be allowed in future? So there are some preliminary expenses which will be disallowed in current year under Income Tax Act, which will be allowed in future, There may be many examples, means we can take n number of examples. Some examples are depreciation expenses not deductible wholly while computing taxable income. For example, preliminary expenses under section 35D, statutory dues deferred for payment under section 43B of Income Tax Act. We know that there are, if the some payment under section 43B can be deferred for allowance, means that is not allowed in this year, or provision for doubtful debt is not allowed under income tax, that will be allowed only when the actual bad debt is incurred, occurred. Understood now? So these are some examples of timing difference. There may be many examples also. Correct. Got this point. What is permanent difference? Permanent difference are those difference which originated in one period but are not capable of reversal in one or more subsequent period. Means that will originate but that will not reverse. Correct. Means, can I say, any expense which is permanently disallowed under Income Tax Act. Any expense which is permanently disallowed under Income Tax Act. For example, penalties or fines which are recorded in our books of account but that is permanently disallowed, means that will never be allowed, it will never allowed in future, that become an item of permanent difference. Or any expense which is allowed permanently under Income Tax Act, for example, weighted deduction or additional depreciation which is not recorded in our books of account but that is allowed permanently in our books of account. Or I say agriculture income is exempted forever. So these are some example of permanent difference. So on permanent difference, because that originate in 1 year and are not capable of reversal in one or more subsequent year, for that no deferred tax effect will be given. So only deferred tax effect will be given for what? Timing difference. Understood? Means, to sum up, can I say, first we need to find only timing difference. Now timing difference, so can I say it can be what? Suppose in the current year and in subsequent year any expense is disallowed in current year and will be allowed in subsequent year. So disallowed in current year will be allowed in subsequent year. It means disallowed, it means we are paying higher tax in current year, and in future because it will be allowed will pay lower tax. It means, can I say, it has some tax benefit in future, because in future it will be allowed. Allowed means, can I say, it will be deducted in computing taxable profit of future. So it will be deducted in computing taxable profit of future. It means in future we are paying lower tax, means it has some tax advantage. That tax advantage we call it deferred tax asset. So in current year, so what we'll do, what will be the, so we need to recognize DTA. So in the current year we'll create DTA, and when it is allowed we'll reverse DTA. We will reverse DTA. So because of this expense disallowed in current year will be allowed in future, we'll create DTA in current year, and when it is actually allowed we'll reverse it. Correct. Second example, we can say any expense which is allowed in current year will be disallowed in future, means it will be added to taxable profit of future. It means in future we are paying higher tax, in future we are paying higher tax, means it is taxable in future. So because it is taxable in future, in current year when it is allowed we'll create DTL. So DTL will be created for this, DTL will be created for this, and when it is disallowed it will be reversed. Understood this point? Have you understood this point? Correct. So can I say in this way कि DTA or DTL will be created on such timing difference, on the basis of nature of timing difference. We need to understand whether the timing difference is taxable or deductible in future while computing taxable profit. So if it is taxable in future, we need to recognize DTL. If it is deductible in future from while computing taxable profit of future, so deductible means it will decrease our taxable profit. It means we are saving some tax. That saving in tax become DTA of current year. Understood? Have you understood this point? Correct. It can be on the basis of income also. Suppose income, any income which is exempted in current year but will be taxable in future. Quite possible it is exempted in current year but will be taxable in future. So for this DTL will be created. And when it is taxable means when it is reversed, will reverse DTL. Correct. Similarly, any income which is taxable in current year but will be exempted means will be disallowed, then we'll recognize DTA. DTA will be created right now because it is exempted, so it will be deducted while calculating taxable profit of future year. So DTA will be created, and at this point of time we'll reverse it. So normally in exam they will ask from expense point of view. Therefore expense is more important than income from examination point of view. And normally under income tax side, expense are disallowed or allowed. Most of the cases. In most of the cases. Got this point? Have you understood? Now based on this we can take any question. But have you understood this point? Now examples of permanent difference are what? Expenses disallowed under section 40A permanently. Agriculture income exempted permanently. Income tax or wealth tax paid is disallowed permanently. Donation not covered under section 80G will be disallowed permanently. Employer contribution to unapproved provident fund disallowed permanently. Penalties or fines are disallowed permanently. So these are some examples of permanent difference. So on this we are not going to create any deferred tax. Correct. Now impact on timing difference. Taxes of initial year being higher and subsequent year being lower, it means we are going to recognize DTA. Correct. Now so this result in creation of deferred tax asset, which means tax on timing difference which are recoverable in future. So this tax on timing difference which are recoverable in future, therefore we recognize DTA. So suppose, just try to understand, suppose provision for doubtful debt is recognized in books of account, that is disallowed in current year. That will be disallowed in current year but will be allowed in the year when actual bad debt happen. So in the future this will be allowed, means will be deducted in computing taxable profit means some tax we are saving future, therefore it is recoverable in future. So in current year we pay higher tax which is recoverable in future, that become deferred tax asset. So when you are paying higher tax, so that is not an expense because that tax is recoverable in future. Because it is recoverable in future, that become deferred tax asset of current year. Deferred tax asset of current year. Once it is recovered, so it will be reversed. Means DTA need to be reversed. Got this point? So what journal entry will do? DTA account debit to deferred tax income, or that deferred tax income will be transferred to profit and loss account. Following timing difference will result in DTA. This already I have explained. Expense disallowed in 1 year and will be allowed in one or more subsequent year. To expense disallowed in current year will be allowed in one or more future year, will give rise to what? Deferred tax asset. Or income taxable in 1 year, it is taxable in 1 year and will be exempted in one or more subsequent year, means it will be exempted from taxable profit in future, so that will be also give rise to deferred tax asset. However, can I say, we all know now that for unabsorbed depreciation and carry forward losses, suppose we have some tax losses or we have some unabsorbed depreciation as per income tax act, so can I say that can be also carry forward for subsequent 8 years. So if you have some tax losses which can be carried forward and that will be deducted from future taxable profit, so we are going to save some taxes on that. So that tax advantage which you are getting in future, that is also recognized as DTA in current year. Correct? Unabsorbed depreciation and carry forward losses which can be set off against future taxable income are also considered as timing difference and resulted in deferred tax asset. So on unabsorbed depreciation and on carry forward tax losses also we recognize DTA, because that also result in timing difference on which DTA should be recognized. Correct? Now taxes of initial year being lower but in subsequent year being higher, it means we are paying higher tax in future, therefore we need to recognize deferred tax liability on that. So this result in creation of deferred tax liability, which means taxes on timing difference which are payable by entities in future. Correct? So what journal entry will do? Deferred tax expense to deferred tax liability, deferred tax expense account debit to deferred tax liability. So the factors, you have the following timing difference will result in deferred tax liability. Expense allowed in 1 year which will be disallowed in one or more subsequent year. So expense allowed in current year as per income tax act, which will be disallowed in future. So when it is disallowed in future, it is added to taxable profit. It means we are paying higher tax in future. Or income exempted in 1 year but will be taxable in one or more subsequent year will also give rise to some deferred tax liability. Understood this much? Now recognition of deferred tax, we all understood that permanent difference do not result in deferred tax. Deferred tax should be recognized for all timing difference. Correct? Now deferred tax will be recognized, means deferred tax will be timing difference multiplied by rate of tax. Chalega? Okay, this is not so much important. I'll come to this point. Correct? Now let me take some questions. AS22. Yes, sir. So you can see first question, Ultra Limited has provided the following information. Depreciation as per accounting record is 2 lakh. Depreciation as per income tax is 5 lakh. It means under income tax act, we are charging higher depreciation, additional, you can say excess depreciation 3 lakh. So this is allowed in current year, which will be disallowed in future. So it will be allowed in current year. So when it is allowed in current year, we are paying lower tax. We are paying what? It is allowed in current year, so it will pay lower tax. But can I say we need to pay higher tax in future because this will be disallowed in future. So we are paying higher tax in future. Therefore, on this we need to recognize deferred tax liability. So you can 3 lakh excess depreciation as per income tax act. Timing difference write down. It will be deferred tax liability. Correct now. And amount at the rate of 50%, they have given tax rate is 50%. So 50% means 1,50,000 deferred tax liability will be created on that. Understood? Unamortized preliminary expenses as per income tax act. So this is actually disallowed and will be allowed in future. So such preliminary expense is unamortized, means disallowed in current year, which will be allowed in future. It will be allowed in future, means in future it will be deducted from our taxable profit, means in future we are paying lower tax and right now we have paid higher tax. So this is recoverable in future, therefore we need to recognize DT on that. So 30,000 is a timing difference, deferred tax asset will be recognized, and on 30,000 50% 15,000. So net deferred tax liability is 1,35,000. This is the answer. Chalega. One more question. Question 5. Omega Limited is working on different projects which are likely to be completed within 3-year period. It recognizes revenue from this contract on percentage on completion method for financial statement during 6, 7, 8, 11 lakh, 16 lakh, 20 lakh, 21 lakh. Means they have applied AS7, and as per AS7, these are the turnover 11 lakh, 16 lakh and 21 lakh respectively. However, for income tax purpose, it has adopted completed contract method, under which it has recognized revenue of 7 lakh, 18 lakh and 23 lakh for all the 3 years. Income tax rate is 35%. Compute the amount of deferred tax asset liability for the following year. So you can see under counting income 11 lakh is allowed income, and taxable income is 7 lakh. It means, can I say the difference is 4 lakh? The difference is 4 lakh. It means, can I say how much income is disallowed right now? So you can see 4 lakh is disallowed, which will be taxable in future. I mean, right now it is not taxable under Income Tax Act, but this is disallowed and will be taxable in future. Therefore, on this we need to recognize deferred tax liability. So on 4 lakh, we'll create a deferred tax liability at a rate of 35%. So that become 1,40,000. 1,40,000. Next year it is 16 lakh, 18 lakh. Now once again it is 2 lakh. 2 lakh. So on this also 2 lakh also, can I say we need to recognize a deferred tax liability, because that is also what? This 2 lakh. Understood? Means actually they are calculating timing difference balance. Means, let me explain it this way. As per accounting income, as per taxable income. So first year, second year, third year, it is how much? They have given 11 lakh, 7 lakh. So 11 lakh, 7 lakh. So timing difference is how much? 4 lakh. Okay, this is timing difference originated. Means what is the timing difference ka balance? Timing difference balance is what? 4 lakh. Balance is 4 lakh. Do in this way. Next year it is what? It is 16 lakh, 18 lakh. So 16 lakh, 18 lakh. You can see now the 2 lakh is actually taxable. It means out of 4 lakh, 2 lakh is reverse. 2 lakh is reverse. So out of 4 lakh, now 2 lakh got reversed, because in this second year you are actually under Income Tax Act, 18 lakh is taxable. So it means timing difference how much reverse? 2 lakh reverse. So balance become 2 lakh. Balance become 2 lakh. Understood? So in the first year originated how much? 4 lakh. Means this 4 lakh was taxable. Out of this 4 lakh, 2 lakh is already taxable in second year. So that got reversed. Now come to third year. It is how much? 21 lakh and 23 lakh. 21 lakh and 23 lakh. Now you can see another 2 lakh got reversed. So this got reversed because this is not taxable in the third year. This become nil. So DTL will be on balance amount at a rate of 35%. So 4 lakh into 35%. How much DTL? 1,40,000. Here 2 lakh ka 35%. How much? This is 70,000. And this become nil. It means this is the DTL balance. Means if you want DTL created oblique reverse. So first year how much created? 1,40,000. Then out of that how much reverse? 70,000 reverse. Then again 70,000 reverse. Then again 70,000 reverse. Means this is the DT expense of first year. This is actually DT income. DT income for second year and third year. Understood? Have you understood this point? So this is better understanding, I will say. In this way you will be able to understand what actually they want to say. Got this point? Have you understood this point? Bolo. Any doubt? No doubt? Yes, sir. So this I hope you have understood. One more question I would like to take. You can say this is simple question. Saaransh Limited closes its books of account on 31st March 2002. They have accrued 5 lakh toward GST liability for the month of March by debiting their profit and loss account, which is expected to be paid by 21st April 2002. It means there was some GST payable which has been recorded as an expense in the books of account. As per the provision of section 43B of Income Tax Act, any expenditure of the nature mentioned in section 43B accrued in SOPL on mercantile basis will be allowed for tax purpose in subsequent year on payment basis only. Means GST when paid, then only it will be allowed under income tax Act, otherwise disallowed. Okay, this 5 lakh which is actually an expense in books of account will be disallowed under income tax Act, which will be allowed in future. So there are some expense which is disallowed under income tax will be allowed means will get some tax benefit in future. So we are paying higher tax in current year and that will be recoverable in future. So on this we recognize the DTA. So DTA on 5 lakh at a rate of 30% means 1,50,000 will be created. Understood? One more question. Let me take one more question. Come to this question. Question 16. The following information is furnished in respect of SLAT Limited for the year ended 31st March 2019. Depreciation as per book 2,80,000. Depreciation as per income tax 1,90,000. The above depreciation does not include depreciation on new addition. Means there was some new addition also. A new machinery purchase on 1/4/2018 means at the beginning of the year for rupees 1,20,000 on which 100% depreciation is allowed as per Income Tax Act. Whereas straight line method is considered appropriate for accounting purpose with an estimated useful life of 4 years. Means 1,20,000 divided by 4. So in books 30,000 will be charged. The company has made a profit of 6,40,000 before depreciation and tax. Corporate tax rate is 40%. Prepare relevant extract. Plus you need to prepare one extract of SOPL. So extract of SOPL बनाते. So if you prepare SOPL, what is the profit before depreciation and tax given? The profit before depreciation and tax is given 6,40,000. Can I say from this we'll deduct depreciation? So depreciation as per books already they have given on old asset 2,80,000 and new asset 30,000. 2,80,000 plus 30 will do 2,80,000 plus 30. So that will be 2,80,000 plus 30,000. How much? 3,10,000. So what is the profit before tax? Minus 6,40,000 is equal to 3,30,000. From this we'll do less tax expense. Tax expense A current tax, B deferred tax. So we need to first find out current tax. Current tax means as per taxable income. So what is the profit before tax? Profit before tax is 3,30,000. 3,30,000. In this we'll add depreciation as per books. As per books whatever has been charged that will be added back. So 3,10,000 will be added back. And we'll deduct depreciation as per income tax. So depreciation as per income tax will be deducted. So depreciation as per income tax is how much? 1,90,000 is allowed on the old asset plus new asset 1,20,000. to 1,90,000 plus 1,20,000 that is 3,10,000. So 3,10,000 will be what? Allowed. So both are same only. देखो 3,10,000 3,000. So taxable income is how much? 3,30,000. 3,30,000. Current tax how much given? Current tax how much given? It is given rate of tax is given 40%. So 40% how much? 3,30,000 into 40% that is 1,32,000. So 1,32,000 become current tax. So 1,32,000 minus कर दो. So 1,32,000 is the current tax. Now we'll calculate deferred tax. Now we'll calculate deferred tax. चलेगा तो deferred tax calculation of deferred tax कर लेते हैं. Now calculation of deferred tax. Correct. So initially just try to understand. There was one as per depreciation, accounting and income tax for old asset. How much was allowed? As per book it is 2,80,000 and as per income tax it was how much? As per income tax it is how much? 1,90,000. 1,90,000. So timing difference is how much? Timing difference 2,80,000 minus 1,90,000 that is 90,000. Correct. Now just try to normally what happens initially the depreciation under income tax will be higher and then subsequently it will be lower. It means can I say this is nothing but this timing difference is nothing but the reversal of excess depreciation already charged. So this will be nothing but reversal. This is reversal of excess depreciation which is already charged, because initially income tax may there will be higher depreciation and subsequently there will be lower depreciation, means this is a reversal, means in this case DTL will be reversed, because now just try to understand when it was excess depreciation was allowed initially, so that time we have paid less tax, but in future we will pay higher tax, and now it is what, now it will be reversed, so it will be considered as reversal of DTL. So this will be actually considered as reversal of DTL. So 90,000 into 40%, how much? 36,000 will be considered as reversal of DTL. Reversal of DTL. Understood? Now for new asset, what is the depreciation allowed as per income tax act? 1,20,000. And how much this as per book it was 30,000. As per book it was 30,000. As per income tax it is 1,20,000. So difference is what? 90,000. This 90,000 was excess depreciation allowed. So allowed, which will be disallowed in future. This is creation of DTL. So on this 36,000 will be created. So in this DTL will be created. DTL will be created. Understood? DTL will be created. Ultimately, can I say 36,000 reverse, 36,000 created. So ultimately net impact is nil. So deferred tax become nil. Deferred tax become nil. Therefore deferred tax will be 0. Deferred tax will be 0. It will be 1,32,000 and this will be 3,30,000 minus 1,32,000. So your net profit will be 1,98,000. 1,98,000 will be your net profit. Understood this point? Have you understood? So once again, this point is very important. Normally we need to assume this only because they have not given information of previous year. So under income tax act, normally initially the depreciation is higher and subsequently it will be lower. So whenever they have given this type of information, we'll assume this is subsequent year. And now under income tax act, the depreciation lower. It means this will be the disallowance of what? Depreciation in current year. So depreciation has been disallowed, which we initially allowed. So initially allowed means that time we created DTL. Now disallowed, it will be reversal of DTL. Reversal of DTL. Understood this point? Have you understood? Yes, sir. I hope you have understood. Chalega? Correct. Now coming to one more important point about a condition for recognition of DTA. Now what AS 22 say that for deferred tax liability there is no condition. We should create deferred tax liability for all types of timing difference for which deferred tax liability should be created. But for deferred tax asset, because that will result in some expected income, there should be some condition, there should be some recognition condition. So what they are saying for DTA, when an entity does not have an unabsorbed depreciation or carry forward losses under tax law, means suppose the company does not have tax loss, means it is a profit making company. For that what they are saying, DTA should be recognized only if there is a reasonable certainty that sufficient future taxable income will be available against which such DTA can be realized. Correct. So if you are a profit making company, just write DTA means what? DTA means what? Ki some expense which has been bolo, are you getting? So some expense which has been disallowed, allowed. Are you able to understand? So you need to understand first this point ki when you are creating DTA, that already I have explained. So this you need to understand very importantly ki this point is very important ki DTA will be created when some expense disallowed in current year, which will be allowed in future. So can you say when it is allowed in future, but if suppose the expense allowed in future is 1 lakh and you have nil taxable profit. So if you have a nil taxable profit, you are not getting any tax advantage. So you will get tax advantage only when you have sufficient taxable profit to the extent of 1 lakh. So 1 lakh taxable profit, from this you deducted and then you are not going to pay any tax. So the tax benefit will be actually recoverable. Your tax benefit will be received only when you have sufficient taxable profit. So therefore what AS 22 want to say that ki DTA should be recognized only when there is a reasonable certainty that future taxable profit will be available against which DTA can be realized. Understood what they want to say? This is important para ki DTA should be recognized only if there is a reasonable certainty that sufficient future taxable profit will be available against which such DTA can be realized. However, when the entity has unabsorbed depreciation or carry forward losses under tax law, suppose you have a tax losses, then you are saying that sir, we have a reasonable certainty that taxable profit will be available in future, so we'll have a doubt about that. So in that case, what AS22 says that if you have tax losses in current year, so DTA should be recognized only if there is a virtual certainty, means chances are more than 95%. When there is a virtual certainty supported by convincing evidence, so you should have a virtual certainty, means the chances should be more than 95% with supporting convincing evidence that sufficient future taxable profit will be available against which such DTA can be realized. Then we can recognize DTA. Means whenever in exam question is silent about future taxable profit, will always assume that sufficient future taxable profit will be available and we recognize DTA. But if suppose question says that sufficient future taxable profit will not be available, then don't recognize DTA. Then don't recognize DTA. Understood is fine. Have you understood? Let me take one question based on this. There is one question given. Ki ABC Company Limited has an investment in venture capital amounting to rupees 10 crore. Means they have done one investment in venture capital. So they have given some amount to venture capital for investment. Venture capital in turn had invested in below portfolio. So venture capital is just one type of entity who will invest on your behalf. So you have given a fund of rupees 10 crore to venture capitalists. So venture capital in turn has invested in below portfolio companies, new startup on behalf of ABC Limited. So they have invested in Oscar Limited, G Limited, Star Limited, Sony Limited. This amount total 10 crore. During the financial year 1920, venture capital has sold their investment in Star Limited. So they have sold this Star Limited investment and realized an amount of 8 crore. So it was sold at rupees 8 crore. So there is a profit of 4 crore. On the sale of shares of Star Limited, entire proceeds of 8 crore have been transferred by venture capital to ABC Company Limited. So entire sale proceed has been transferred to ABC Limited. Means 8 crore is received by ABC Limited. The account manager has received the following additional information from venture capital as on 31st March 2020. 8 crore has been deducted from the cost of the investment and carrying amount of the investment at year end become 10 crore. You can see the total investment in venture capital was 10 crore. From that they have deducted 8 crore. So carrying amount of the investment become 2 crore. It means, can I say, in accounting they have not recognized any profit, correct now. But as per income tax act, this 4 crore will be taxable. This 4 crore will be taxable. Company had to pay a capital gain, likha hua hai, capital gain tax at the rate of 20% on the net sale consideration of 4 crore. So as per income tax act, the company need to pay tax at a rate of 20% on the net sale consideration, means that is 4 crore. Due to COVID-19, the remaining startup Oscar Limited, G Limited and Sony Limited are not performing well and will soon wind up their operation. Means all the other investment they are not performing well and they may wind up. Means quite possible, can I say, we may need to incur some losses in future. Correct now. Venture capital is monitoring the situation and if required, they will provide an impairment loss in June 2020 quarter. So for this investment, they may provide some impairment loss. You need to suggest the accountant management what should be the correct accounting treatment as per AS22. So can I say, first we need to find out as per income tax act what can be the current tax. So 8 crore minus 4 crore. So 4 crore is the taxable income. On that 20%, the 0.8 will be your current tax. This will be current tax. Now coming to deferred tax. So current tax will be how much? 0.8 crore. Now coming to what? Deferred tax. So under taxable income, this is 4 crore, but under accounting income it is nil. It means, can I say, 4 crore is taxable in future. 4 crore is taxable in current year, which will be disallowed here, exempted in what? Future year. So it is taxable in current year, which will be reversed in future, means it will be disallowed in future. So disallowed means it is deductible in future. Therefore, can I say, on that we need to create some deferred tax asset. So on 4 crore we need to recognize deferred tax asset. But can I say, it is given the question due to COVID-19 they are supposed to recognize some impairment loss. So it is quite possible now there is no reasonable certainty that future taxable profit will be available against which such DTA can be recognized. Therefore, no DTA will be recognized. Understood what I am saying? So as per AS20, DTA should be recognized and carry forward only to the extent there is a reasonable certainty that sufficient future taxable profit will be available against which such DTA can be realized. Got this point? Since in the current scenario due to COVID-19 the portfolio company are not performing well, thus company may not have sufficient future taxable income which will reverse DTA. Therefore, company should not recognize DTA of 0.8 crore. 0.8 crore means 4 crore ka 20%, and the company should recognize only current tax liability of 0.8 crore. So they will recognize the current tax but no deferred tax. Why? Because the company has no future taxable profit against which that DTA can be recognized. Got this point? I hope you have a good question. It can be asked in exam. Understood? Correct? Yes, sir. This much you have understood? Correct. Now coming to one important point about section 115JB. Now I hope you might be knowing or you might not be knowing about MAT, minimum alternative tax. Have you done under Income Tax Act? Quite possibly you have done. Now as per Income Tax Act, the entity need to pay a regular tax and you need to pay tax based on what? Higher of regular tax or MAT whichever is higher. Means as per Income Tax Act, tax payable is regular tax and MAT whichever is higher. Whichever is higher. Understood? Means regular tax is nothing but the regular tax rate as per 30% and MAT will be as per 18.5% on book profit as per section 115JB. So in that case, how to do the calculation of deferred tax? Correct now. So I will take one question because this question has been asked in exam, therefore can be repeated. Okay, but from my point of view, this type of question should not be asked in exam. CA inter exam. From the following details of A Limited for the year ended 31st March 2001, calculate deferred tax asset liability as per AS 22 and the amount of tax debited to PL account. They have given accounting profit 6 lakh, book profit as per MAT and profit as per Income Tax Act. This is actually taxable income. Taxable income. Now 6 lakh becomes 60,000. It means what? Ki there are some expense which has been allowed in current year which will be disallowed in future. So expense allowed under Income Tax Act, which will be disallowed in future. So expense allowed in current year which will be disallowed, but we need to recognize DT or DTL. So which will be disallowed in future means will be taxable in future. So taxable means we'll recognize DTL because right now we'll paying lower tax on that, so higher tax in future. Yes sir, this I am explaining. And book profit as per MAT is given 3,50,000. So on this we'll calculate MAT. So just write down in question number 2. First we'll calculate current tax. So current tax will be higher of A and B. A means taxable income multiplied by regular tax rate means 30%. So taxable income is given 60,000. 30% is what? Regular tax rate. It become 18,000. And MAT, minimum alternate tax, it means book profit whatever is given into what is the MAT rate is given. It is given 7.5%. Acha, tax rate is now isko change kar do. I am changing this because now it is 30% and 18.5%. Correct now. I am changing this. Okay, because now if this question come, it will be 30% and 18.5%. However, we do as per the information given the question. So I am applying the information given the question only better. So in this we create at the rate of 20%. So 20% become how much? 60,000 ka 20% how much? That is 12,000. And book profit it is given 7.5%. Now it become 8.5%. 18.5% now. But we'll do as per the information given the question. Book profit is 3,50,000 into 7.5%. It is 26,250. So this is higher. The current tax will be 26,250. Understood? So current tax will be 26,250. This you have understood? And can I say we need to also recognize the deferred tax because we have some expense which is allowed in current year will be disallowed in future, and that is nothing but how much the difference. So the accounting income minus taxable income will do. Accounting income is given how much? 6 lakh. Taxable income is given how much? 60,000. So that is 5,40,000 into what? 20%. So 5,40,000 into 20%. So 1,08,000 will be deferred tax liability. So this will be deferred tax liability. So your tax expense will be 26,250 plus 1,08,000. 1,08,000. So 26,250 add कर दो. So this will be 1,34,250. This will be your tax expense. 1,34,250. Understood? That is only given, I think so. Your tax expense will be 1,34,250. Understood? Now they have done in some other way. Means they have done in some other way. I'll just try to explain what they have done. Means what they have written. Tax expense they have written is current tax plus deferred tax. Understood? They have given in this way. Got this point? Correct. Now tax expense will be what? If I am saying tax expense will be on 6 lakh, if I am saying this will be 6 lakh ka 20%, that will be tax expense. So this will be 1,20,000. Current tax based on regular tax, that will be 12,000 plus deferred tax. So they have calculated deferred tax on this way. 1,20,000 minus 12,000, that is 1,08,000. Means I am applying concept, they are applying one shortcut. Understood? Now just try to, because in the current year we are paying some excess tax due to MAT. Therefore they are saying tax expense will be 1,08,000 deferred tax plus what? 12,000. And how much excess you are paid? Excess, how much you are paying? 26,250 minus 12,000, that is what? 14,250. They are adding 14,250 यहाँ पर. So that is actually current tax. So this is become that same amount only. Means they are solving in this way, but you can do as per my way. That is more. It is better to understand in this way. Current tax will be higher of these two, and deferred tax will be this. So your tax expense will be 26,250 plus 1,08,000, that is 1,34,250. Understood? Got this point? Now one more point is that about the tax holiday. Do you know about tax holiday? There are some section under income tax at about 10A, 10B in which some tax holiday period is allowed. For the tax holiday period means for 10 years no tax will be, no tax means entire tax is exempted. So that is known as tax holiday period. Now in that case what AS 22 want to say, if there is some timing difference which is originated in tax holiday period and are reversed also in tax holiday period, for that no deferred tax. So what they want to say, deferred tax in respect of timing difference which arises during the tax holiday and get reversed during tax holiday period should not be recognized. Means for that timing difference no deferred tax should be recognized. But any deferred tax in respect of timing difference which originated in tax holiday period but will be reversed after tax holiday period, then on that we need to recognize deferred tax, and the reversal will be done on FIFO basis. So one explanation has been given. For example, just try to understand. Suppose this is what? Tax holiday, tax holiday, tax holiday, and after that you have to pay tax. Now suppose some timing difference originated in this year and it will reverse 25,000 in first year, 25,000 in second year, 25,000 in third year, and 25,000 in fourth year after this. Now the question is that on 1 lakh should we create deferred tax? So देखो originated in tax holiday and this 50,000 is reversed in tax holiday. So if it is getting reversed in tax holiday period, so no tax advantage, no tax disadvantage. So on this no deferred tax. But whatever is reversed during after tax holiday period, on that we are actually getting some tax advantage or tax disadvantage. So out of this 1 lakh, 50,000 may no deferred tax, but on 50,000 will recognize deferred tax. This they want to say. Let me take one question, because this question can be also asked in exam. Question number 6. Y Limited is a full tax free entity for the first 10 years of its existence and the second year of its operation. Depreciation timing difference resulted in a tax liability for year 1, year 2, 200. For year 1, 200 and year 2, 400. Means year 1, year 2, 200 and 400. From a third year, it is expected that timing difference would reverse each year by 10 lakh. So can you say Y3 to Y10 10 because this is tax holiday period. It will be 10 into a 8 means 80 will be reversed during what? 80 will be reversed during tax holiday period means out of 600, 80 is going to be reversed in tax holiday period means on that no deferred tax. Means can I say out of 200, 80 will be reversed in the tax holiday period means only we need to recognize deferred tax liability on 120. Correct. And for this 400 we need to recognize entire deferred tax liability. That they want to say, if you read, out of this 200, 80 will be reversed during tax holiday period. So we need to recognize deferred tax only on 120 lakh. And for the second year 400 lakh, we need to recognize entire deferred tax because that timing difference will reverse after tax holiday period. Understood is fine. This complete your entire AS22. I hope you have understood all the points. If you have understood this much, now any question can be done. There is one more point about offsetting. This type of question can be asked in MCQs. Can we offset current tax asset with current tax liability? Well, yes, if two conditions are satisfied. First, entity has legal enforceable right to set off the recognized amount, and entity has an intention to settle on net basis. So there are two conditions given to offset current tax asset with current tax liability. Means suppose 1 year the amount is payable, other year the amount is recoverable, refundable. So can you offset in the balance sheet? Can we write on one single amount? Well, yes, if the entity has the legally enforceable right to set off the recognized amount and entity has the intention to settle on net basis. Correct. The second point is can we offset DTA and DTL? Well, yes, if the entity has a legal enforceable right to set off current tax asset with current tax liability, and the deferred tax asset and deferred tax liability both relate to the income tax levied by the same governing taxation law. Means both are as per Indian Income Tax Act. Then we can set off. So if these two conditions are satisfied, then we can set off DTA with DTL. However, not so much important from exam point of view. Disclosure, I hope you have understood. This was the overall point of deferred tax AS22. So I think I have done all questions from exam point of view which may come in exam for this chapter. Understood? So for this much was from my side. I think revision has been done. Thank you very much. We'll meet again in the new session with one more accounting standard. Till then, bye bye. Take care.